Build your dreams, live rich, and leave rich.
Welcome. Now, for just a moment, I want you to forget about stocks. Forget about company earnings. Forget about balance sheets. Today, we're talking about the market for things you can actually, well, you can touch them. The raw materials, the physical stuff that literally builds our cities and fuels our cars. We are going to pull back the curtain on the giant global wholesale market, the global Mandy where the planet's most essential resources are traded.
It's a really simple question, isn't it? But the answer? Well, the answer reveals a massive split in the financial world. Because you see, when most people hear the word trading, their minds immediately jump to one very specific thing. And that makes perfect sense, right? When you buy a stock, let's say a share of an IT company, what are you buying? You're buying a tiny piece of ownership in that business. You're putting your money on their management, their innovation, their ability to make profits. You are, at its core, trading an idea. And this is the market for commodities. This isn't about abstract ideas or future profits. It's about physical goods. The best way to picture it is as a giant global wholesale market, a global Mundi. Imagine it, a place where the planet's most fundamental resources, everything from gold to crude oil, are being bought and sold every single second of every single day. So what are these building blocks exactly? When we talk about this massive global marketplace, what is actually being traded? Well, here in India, it really boils down to four core categories. On our Indian exchanges like the MCX and NCDX, these are the pillars. First, you have bullion, that's your gold and silver, the ultimate stores of value for centuries. Then you've got energy, the crude oil and natural gas that literally power our world. Next, base metals, the copper, the aluminum, the zinc, that form the skeleton of all our industries. And of course, agriculture, the food we eat and the cotton we wear. Make no mistake, these aren't just tickers on a screen. They are the absolute core components of human civilization. Okay, so you might be thinking, if I buy a contract for, say, 100 barrels of crude oil, does a tanker truck actually pull up to my house? Thankfully, no. The way we trade these physical goods today has become incredibly sophisticated, and it's all thanks to one key financial innovation. You can see the evolution right here. You know, in the old days, trading commodities was messy. It was chaotic. You had to worry about who you were dealing with, how you'd get this stuff delivered, and the specific terms were different for every single deal. But today, all of that chaos has been replaced by the order and elegance of futures contracts. These are standardized agreements, traded on a centralized exchange, and they solve all those old problems. So here's the most crucial point to understand. A futures contract isn't the physical good itself. Think of it as a digital promise. It's a legally binding contract to buy or sell something later at a price that you both agree on today. And it's this standardization, this fact that every contract is the same, that allows millions of these digital promises to be traded seamlessly all around the world every single day. But why? Why was this entire system even created? What fundamental human need does it actually solve? Well, the entire purpose of this massive market really comes down to just two types of players, with two very different goals. We can think of them as the shield and the sword. So on one side, you have someone who's desperately looking for protection. We call them the hedger. And on the other side, you have someone who is seeking profit from risk. That's the speculator. And believe it or not, the entire market, all this buying and selling, exists because of the constant dance between these two forces. Hedging at its heart is all about defense. It is a financial shield. Think about it. Businesses that either produce or consume raw materials are constantly at the mercy of wild, unpredictable price swings. A futures contract gives them a way to protect themselves, to shield themselves from that volatility. To really get this, let's use a simple example. Let's follow the story of a business you see every day, a humble biscuit manufacturer. So here's their problem. They know for a fact they will need 10 tons of wheat 3 months from now to keep their factory running. But what's their risk? They're terrified. What if a bad monsoon hits or some global event causes wheat prices to double? Their entire business, their profits, could be completely wiped out overnight. So what's the solution? They use their shield. They go to the futures market and buy a contract that locks in today's price for the wheat they'll need in 3 months. Just like that, they've hedged their risk. They are safe. Now, that's the key question, isn't it? The biscuit maker wants to get rid of their price risk. So who in their right mind would be willing to take it on? Enter the speculator. This could be you. This could be me. This is a trader who believes they know where the price is headed, so they take the other side of the biscuit maker's trade, willingly absorbing that risk. They have no interest in the actual wheat.
They are using their financial sword to make a bet on the future price, and in doing so, they provide the essential liquidity that allows the hedger to find protection in the first place. So you see the dynamic. We have the hedger who wants to avoid risk, and the speculator who wants to take risk. But what is it that makes this market so incredibly powerful and so incredibly potent for both of them? Well, it all comes down to the most powerful and the most dangerous force in all of finance. Leverage. This one word is what makes commodity trading so incredibly attractive and also what makes it so unbelievably risky. In simple terms, what leverage means is that you can control a very, very large position with a relatively small amount of your own capital. Let's just use a real-world example to make this clear. Imagine you want to trade a gold contract. The total value of the actual physical gold you're making a bet on, that could easily be 10 lakh rupees. But here is the magic and the danger. You don't need the full 10 lakh rupees. No. The exchange only requires what's called a margin, which is really just a small good faith deposit. So in this case, just 1,70,000 rupees lets you control a position that's almost 6 times larger. Now, this is a double-edged sword. A tiny price move in your favor can lead to massive percentage gains on your money, but a tiny move against you can lead to absolutely devastating losses. And this brings us to our final and most crucial takeaway. As the National Institute of Securities Markets itself warns us, this market is a two-sided coin. It is a vital tool for businesses to manage their risk, but it's also a highly leveraged arena for speculation. The potential for high returns comes hand in hand with the very real risk of even higher losses. So the question I want to leave you with is this. When you step into this global Monday, are you wielding a shield for protection or a sword for speculation? Because understanding that difference